Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I'm Ed Vincent, and with me today is SRA Watchtower's Director of Implementations and our resident Chief Risk Officer and Chief Operating Officer and guru who has lived and breathed every role inside of a financial institution, seemingly, Kathy Jackson. Kathy, it is great to have you back with us today. Thank you for being here.
Happy to be here. Looking forward to the conversation.
All right, today we're going to talk about something that is timely given when we are releasing this episode, which is at the beginning of the year. And we're going to talk about this concept of looking at the KRIs that an institution is monitoring, and really taking a hard look and a close look at, are those the right KRIs, and are they stale? Are they accurate? Are they too many, and are they still applicable? And really, this question of maybe I'll call it KRI health is probably the catch-all. So let me start with the question of why, when an institution identifies a set of KRIs, why isn't it simply set it and forget it? We've done work, we've identified what's important to us. Why doesn't that persist forever?
Right. Because your business is constantly evolving, whether internally or externally. There's things happening on the outside that are going to impact your business, and there's things happening on the inside. And so the KRIs have to evolve. Maybe there's a standard set that you keep, but you definitely have to go in and look when you're making moves. You're adding additional products. Do you need to take a look at some underlying values and metrics that will help signal, that something's causing an issue? And then how can I monitor that issue? And so they have to evolve as you evolve.
I love that word, right? I think of being dynamic. I think the word evolve is a great, really very pointed way to articulate that. All right, so let's then take that premise that, right, we live in a dynamic world, right? Financial institutions evolve, the marketplace evolves, the regulatory environment evolves, the strategy evolves, and these key risk indicators need to evolve as well. What is the right frequency and timing to go and look at these KRIs, right? Is this something that needs to occur each and every day? Is it right once in a blue moon, right? How do you think about the right time to take a pause and look and evaluate, right? Have things evolved?
Well, there's a couple of things. Of course, your KRIs need to underpin your strategy. So definitely, whenever you're reviewing your strategic plan, you're going to take a look at your KRIs because they should be in alignment with your strategic plan. Of course, if you have an event that comes out of nowhere, you have a loss or near loss or potential loss, and it came out of nowhere, maybe there should have been some indicators in place for that. And it's a time to take a look and establish those. You have an examination or an audit again. If a key issue is brought to your attention, you're going to see, how can I know more about that, and how can I know that's happening or coming? And of course, as banks, we love to look at everything annually. So definitely an annual look at a minimum.
All right, so let's unpack that now and say, all right, you've whether it's a one-off event as you articulated, right? Feedback from a regulator, or something happens in the marketplace that triggers you to say, all right, something needs to evolve here with us as an institution. You're now about to embark upon this process. Take us through what that looks like, right? You counsel, right? One, you've lived it yourself, right, inside a financial institution, right? So you've got that experience, but you've also taken a number of SRA Watchtower ERM or RCSA or other risk maturity framework users through this journey. So how do you take someone through this journey of evaluating the efficacy of KRIs?
Right. That first statement I made, that they really need to be in alignment with your core objectives, of course. Then you're going to assess your risk areas and determine the key areas where you're most vulnerable. And they are called key risk indicators for a reason. You can have tons of risk indicators, but they're certainly not all key risk indicators. And every risk area is in a key area, right? Then you're going to prioritize your risk. All your risks aren't equal. And while you might have key, but even within the key risk, right? There's a hierarchy even within your key risk. So prioritize those risks. So important to set your risk appetite. That helps define the level of risk you're willing to accept, which again is going to help determine which risk KRIs you need and how you're going to measure those. Go ahead and look at industry standards and best practices. Get some external information around those key risk indicators. And then super important, consult your stakeholders, the people who are key stakeholders, management and employees who really know that piece of business. They can generally give you a comprehensive view of those potential risks. And while you're having those conversations, that's a great time to identify what data is available. What do we have? What metrics are you looking at? What metrics has our research indicated we should be looking at? And if they're available, awesome. If they're not available, assess whether or not getting those is a lift you can handle right now. If you can't handle it right now, put it on your roadmap list. Start gathering the information that you need to get that information together and be able to use it. And then that last step is, of course, to review and adjust them. Regular review them, make sure they remain, as we said, relevant. But you've got to keep the number manageable. Too many is overwhelming. It's difficult to effectively monitor too many. And so that's the thing. You can have too many, and of course, you can have too little, because you need to aim for a balance that provides comprehensive coverage, but not, overly complex. And so those are the things that the kind of the steps to getting those right-sized for your organization. And as we talked through those, you can see how it's important to continuously review those because things do change.
Kathy, you hit on a number of really interesting themes there. I'm going to try and bucket them into some concepts that, well, one was, the external dynamics, if you will. So industry standards and best practices, right? I know that you've got a set of essential and foundational key risk indicators, which you use as a starting point when you have conversations with institutions. One of the things that you evaluated when you created those sets was a set of standards. There are 2 states that have programs where institutions share information on a monthly basis with their state regulators. They each have a set of somewhere between 40 or 50 to 60 indicators that they use, and I know you use those as concepts, as well as the 100 institutions that use Watchtower's ERM system. So there's that external piece of what are the best practices that are out there, right? Regulatory guidance. So obviously it's feeding into that. Then I think the bucket that I would say is that you talked about consulting stakeholders, right? Aligning with objectives, like looking at risk appetite. So, that is, I'll call that a bit more internal, right? Understanding that the characteristics of the institution and what really matters to them. And then the last dynamic, which I noted down here, was this concept of, I'll call it pragmatism. So the data's got to be available, right? There can't be too many of these. It's got to be digestible and consumable. You've got to present this in a way where people's eyes are not just going to glaze over because you've got so much data. that you don't know what to do with it. You know, I was with a risk officer of about a $20 billion bank in the Midwest recently, and he said for years the regulators had been coming in and telling them to add more KRIs, add more KRIs, add more KRIs. So each time they'd have an exam, they would come out of it and they'd add, 5 or 10 or however many KRIs. And he said that most recently the provincial regulator was in there and they said, "You have too many KRIs. How do you manage these? How do you digest these?" And he said he was confounded with how to even respond because they had been over years building all this up, driven
Right.
by the regulators, and now the regulators said, "Well, how do you manage it?" And so we had a conversation about well, how do you make it manageable? You can slice and dice it in ways where you only present and consume the KRIs that bump up against your risk appetite or have changed direction or who are trending towards you know a zone that is alarming, going to raise an alarm. So I think that gets to your last concept there of being pragmatic here. The data's got to be available, it's got to be consumable, and you've got to have something that can be actioned, if you will, by the business.
Those are great buckets to put that in, Ed. It captures exactly that process. Again, just making sure that you just aren't picking up every single thing that could possibly happen, that might not move the needle at all. Aligning those with your identified strategic risk, your identified emerging risk. All those things will help that North Star view. Where are we trying to go? What might keep us from getting there? What might keep us out of trouble? Those are the things that are key. And so those are the things you put your eye on. And it does help everyone to articulate things with a risk lens in addition to all the others. We're worried about this and that. End of the day, every business has risk and everybody has to deal with those risks. And so it's just getting everything in alignment to remember, oh, yes, we want to open 10 branches. Sounds good, but what's the risk? Just
Yes.
keep coming back to that, keep coming back to that.
I like that. I'm going to incorporate into my kind of notes here. You used the word key there, multiple
Over
times,
and
and I think
over.
I should have pulled that into my second bucket there, right? Aligning right with internal objectives and strategy, and it is right. It also probably bleeds into the pragmatic concept of saying, right, what is key? What is most important? So I'm gonna put you on the spot here, Kathy, and ask you the $64,000 question, which is right. What is the right number of KRIs, right? How do you think about that, right? What is manageable? What is digestible? When someone asks you that question, how do you formulate a response?
Yeah. The right answer is there isn't an answer for a number. It's about coverage. Are you covering all of your key areas with indicators that allow you sort of to get a leading view of something's happening that might cause this risk, right? And then
Yep.
lagging this, what metric might signal this risk is starting to emerge. And so cover your risk. That's the right number. When you cover your, say it again, key risk areas.
Fantastic. I've written that down in all capital letters here, and I'm now underlining key multiple times. So I think you've really given folks some great things to consider here, Kathy. I imagine that I'm going to go out on a limb and say that you'd be happy to take calls from anyone, right, to talk about this matter, right? You've gone through it a bunch of times. This is right in your wheelhouse.
Oh, it absolutely is. And I love the conversation.
Terrific. Well, I'll try and bring this all back together here, right? This concept of the fact that businesses are dynamic, they evolve, and so your KRIs have to evolve as well. So, the first pillar, if you will, around KRI health is acknowledging that they need to evolve. The second is that right that that there are triggers, right? When you're looking at that strategic plan, when there isn't when there is an event, right? There are moments in time, in addition to just the best practice of looking at this stuff annually. And then once you do decide to embark upon that evaluation, looking at one, industry best practices. Number two, alignment with objectives and strategic plans and key objectives there. And number three, being pragmatic, right? What data is available, right? What is consumable? And then that brings us to our last point here of the fact that the right answer here is going to vary by institution as to how many KRIs you have. When you go in there and you begin this journey to evaluate those KRIs, your outcome is going to be different depending upon who you are as an institution. But the thing that is critical is that you have to cover all those key risk areas. And I think that that's a great way to summarize it, Kathy.
Perfect. Perfect.
Wonderful. Thank you very much. Appreciate the insights and the perspective, and we look forward to having you back on a future episode.
Anytime.